Hi, everyone. Welcome to today's discussion. Thank you for joining. Today, we'll be discussing fraud and AML compliance trends, tactics, and outlook for 2024. My name is Erica, and I am on the customer success team at Unit21, helping our customers get the most out of the platform to stop bad actors and fight financial crime. I will be our moderator for the conversation today. For those of you in the audience who are less familiar with Unit21, we provide the infrastructure to detect, investigate, and report bad actors through the customer lifecycle. We offer tools and advanced analytics to help organizations fight fraud, money laundering, and other illicit activities. Before we kick things off, a couple of housekeeping reminders. First, this session is being recorded and will be emailed to everyone on this call in the next 24 hours. And second, at the end of this session, we'll host a live Q&A, so please submit any questions that you have during the session via the Q&A button on the bottom of your screen. All right, so why are we here today? As risk and compliance teams look to 2024, it's important to set up your FrAML program for success. Unit21, together with FS Vector, are here today to share some guidance on the changing fraud and AML landscapes. We'll start by unpacking FrAML as a term, then we'll dive into fraud trends, then we'll walk through some themes in AML and finish up with a live Q&A. So let's kick things off by introducing today's panelists. Alex, why don't you go first?
Thank you, Erica, and hello to all our global audience. My name is Alex Fajvosovich. I am the head of fraud risk here at Unit21. I've been a fraud prevention practitioner for the past 15 years, working in fraud operations, fraud analytics, consulting, and today I'm leading the fraud and the risk at Unit21. So pretty much anything related to product marketing, success, implementations, and go-to-market. If it has fraud prevention in it, I probably have a small say in it. Happy to be here.
Alex, probably more than a small say in that, but it's great to be here. Erica and Alex, thanks very much for having me. Chris Seidler, a partner at FS Vector. We're a boutique fintech advisory and advocacy firm. I'm on the advisory team. Our bread and butter really is helping fintech firms early in growth stage, as well as some of the more mature firms, to design their products, build their products, design and operationalize regulatory compliance programs, and go to market. And we do a whole host of other things as well, including having our advocacy team, the number of registered lobbyists in the Washington, D.C. area. Many folks on the FS Vector team, including myself, come from a background in financial crime compliance. I've spent probably the better part of 2 decades in this space, in living in the UK, working with non-US depository institutions, and then moving to the US about 12 years ago. My former position, I was the co-head of the FinCrime Compliance Advisory Practice at Promontory Financial Group, but very happy to be here and look forward to the conversation.
Awesome. Thank you both. We've got some great speakers today, so let's go ahead and jump into it. Starting by unpacking FrAML as a term. So FrAML is the combination of fraud and AML to increase operational efficiencies and effectiveness for both risk and compliance teams. Alex and Chris, before we dive into today's tactics and best practices, I'd love to hear your thoughts on FrAML as a concept. Alex, why don't you start?
Absolutely. I'm watching the head count on the participants, see how many people dropped after they saw the word FrAML in big red script. But yeah, it's funny because it's so polarizing. I actually ran a small survey on my LinkedIn page a week ago, saying simple question: tell us, is FrAML is a valid concept, yes or no? And I had about 80% of the people saying yes, of course, and the rest saying no. And most of the people who said no actually compliance people. So that was a very interesting insight to me. Personally, I think I came across the term FrAML when I saw Verafin publish the FrAML for Dummies ebook, which was a very interesting intake on the concept. But in general, if you think about it, FrAML was adopted by most of the new age vendors in risk and compliance simply because it allowed them to create the space to penetrate the market that was being dominated by several legacy players for many, many years. And if we think about the risk and compliance space in general, 10, 15 years ago, compliance teams were very compact, very siloed. The communication with those teams were very one-way street. So they collecting a lot of signals, collecting a lot of data, not sharing much outside to the organization, mostly working directly with the regulator. So in a way, it actually created a problem that we are seeing today with larger financial institutions, which is the siloed data. So you have teams who don't have access to the data they need. We have problems of data flow between different teams. And I personally think that FrAML is a concept, is a great way to achieve operational efficiency. I'm not saying if you are a BSA officer, you need to show your SAR filing to the whole team, or any risk personnel in your financial organization must have access to everything you're doing. You still have the right and the obligation and the responsibility to keep everything from the majority of the people, so they don't have access to it. But I think if we just focus on the operational perspective of having one infrastructure for the all relevant risk employees at your organization to work together, I think for me personally, it makes a lot of sense.
Yeah, I mean, I think Alex is right. I mean, historically, there was a bit of a tension there, maybe between the AML folks and the fraud folks. And I appreciate where you're coming from there, Alex, on maybe the 20%. I would say it's more than just an operational thing these days. I think there's a very real effectiveness component to this. You think about like a quarter of the SARs filed to FinCEN last year from depositories and MSBs were categorized as related to fraud. So there's clearly like an overlap there that one can't really miss. I think it's also true that historically these have been different teams within larger organizations. They tend to solve for different related but different things. Like fraud folks are dealing with mitigating fraud losses. AML folks are dealing with detecting and reporting potentially suspicious activity, and they work different timelines in different groups and often on different systems. I think with the passage of time and new challengers and the incumbents maybe smartening up a bit, we're seeing that there's just a closer and closer alignment here. So I probably would have been maybe in that 20%, a couple of years ago. I'm definitely in the 80% today.
Awesome. Well, thank you both for sharing your thoughts on that. And before we move forward, I'd love to hear how everyone's in the audience feels about FrAML. So I'm going to pop a quick poll on the screen. Please take a moment to share how you are or aren't approaching FrAML in 2024. We'll be sure to share these results here in a few. I see some questions, some results coming in now. Okay. These are completely anonymous, so don't be shy. All right. I'm going to end the poll here in 2 seconds, last few seconds to pop in your answer. All right. Let's look at these results. Chris, Alex, what we expected, what we didn't.
Well, look, first reaction is maybe the folks who got turned off dropped off, and the FrAML term didn't frighten the rest of you off. But looking like 71% there, saying it's relevant to folks server 2024 is that says something, right? So I'm glad it's that way and not the other way around. We'd have a harder time for the rest of the discussion.
Yeah.
All right. Well, now that we have a good read on how everyone in the audience is approaching FrAML, let's go ahead and dive into our first topic. Apologies here. Expected fraud trends for 2024 and how organizations can prepare. Alex, kick us off with this one.
Yes, of course. So I don't like to call it trends, as I'm not big on predicting things. But if we look general at where the fraud prevention market is headed and where the fraudsters are headed, I think we're in for a treat for 2024. And first of all, I'll start with first-party fraud. Big shout out to all the leading voices in our small community who've been talking about first-party fraud pretty much ever since the pandemic started. So for the past several years, we started to shift the attention on financial institutions that first-party fraud is a real thing, and it's actually have the potential to be a bigger threat than third-party fraud. Historically, we've been victimizing our customers. We always say, and the customer is the victim, third party have attacked them, took their card, took over their account, stole the checkbook. How do we protect the customers? Today, finally, I think, this year, 2024, many financial institutions understand that there's equal importance to protecting the financial institution and protecting the customer. And when we're protecting the financial institution, we need to protect it from first-party fraudsters, which are entities who we onboarded, who pass KYC, pass all our onboarding guards and rails, and now they're operating on our platform and trying to create financial damage to the organization. So I think in general, first-party fraud will be a huge topic for this year, and we will see more financial institutions also understanding how to report first-party fraud and how to differentiate the losses they see from a third party to a first party. Now, the second outlook I want to touch is everything that has to do with KYC and identity verification space in general. On one hand, the past 3-4 years have been a true renaissance for this space. I mean, I remember how KYC vendors used to be, 5-6 years ago, and I see what they offer today. I was lucky enough in last October to be in Las Vegas for Money2020, and I've seen, I want to say 6 or 7 demos of different KYC vendors, and the stuff that they provide out of the box are pretty impressive. But on the other hand, if we really try to see what are they offering, I feel like, in a way, the capability and technology is at its peak. So we won't see much more advanced in how do we actually verify someone's identity. So now all those vendors are focused on adding additional tools and capabilities that can help you not verify the identity, but more be focused on identity assurance, right? Have a better way to create, to verify if a selfie of a person is real, have a better way to verify if the document that we're scanning is an actual valid document, and how do all those elements correlate with each other. So I think many financial organizations were focused on having a strong onboarding in place in the past several years, but now we will see a shift to continuous transaction monitoring. And shifting to continuous transaction monitoring is important simply because if you are relying on best practice or out-of-the-box flow that your identity verification vendor offers to you, chances are you won't be very satisfied with the results. Because if you think about it, fraudsters do understand eventually how your workflow, how the flow is working, and they will understand how to bypass KYC. So on one hand, you will say, hey, I might have actually pretty high auto approval rates, which is amazing, and I don't need to escalate a lot of manual work or manually verify identities. But on the other hand, you need to have some type of feedback loop from your continuous transaction monitoring back to your onboarding strategy. And you need to be able to differentiate. If you onboarded the user and they ended up with a fraudulent activity, you have to be able to differentiate whether this fraudulent activity was a third-party fraud, was it a first-party fraud, and send the right feedback back to your onboarding process. So you have much better control on the onboarding funnel that you have. You understand how many people start your onboarding process, how many people end your onboarding process, and where you fit the right strategies to stop potential bad actors. The third point I want to talk about is the new account fraud strategies. So if we think that it's much easier for first-party fraudsters to onboard to your platform, we must assume that they really understand what are the product capabilities your platform offering them from day one. we did a small exercise in Unit21, and we actually tried to understand, based on the data that we have from all of our customers, how new account fraud is trending and how it differentiates between different types of financial organizations. And I can tell you that if we look at the space of traditional banks and credit unions, the first 3 days from account opening shows the highest risk for those organizations. So the highest true positive rates for the rules that we deploy for them happening in the first 3 days. While if we look at the fintech space, we see that the actual risk comes slightly later, around day 7, day 8, sometimes day 9. And I think the reason for that is because fintechs and traditional banks have slightly different product offering from day one for their customers. Many fintechs today are allowing full capabilities after you make your first direct deposit, versus maybe a traditional bank who will give you the whole bells and whistles from day one. So if you operating in that space, whether it's for consumers or for businesses, it's important to understand that your product offering, especially for new accounts, will directly impact the fraud rates you're seeing, and it will directly impact the way you will see new account fraud on your platform. So it's also important to have the right controls. And I don't think there is a one size fits all, but you need to understand what features you give to what users, and whether or not those features are actually at the right scale for those users. For example, if you have, let's take something outrageous. If you have platform for bank accounts for teenagers, but you allow those teenagers to bring hundreds of thousands of dollars in and take this money out fairly easily via different channels, this is probably not a good product fit, and you probably need to have some type of thinking on what those people who genuinely want to onboard to your platform actually need, versus just giving everybody unlimited access to bringing funds in and out. The next point will be consortium. So if we feel like we're at a point where we have a KYC program in place, we have some control on the onboarding, but we still see first-party fraud coming in. And even with a good feedback loop, you still in a pretty much reactive mode. So how you really become proactive and not reactive when it comes to first-party fraud? And I think the best answer for that is you need to consider joining some type of a consortium program that will allow you to get better insights into what other organizations already experience with that entity that you just onboarded. And I personally believe that the next 2-3 years in the consortium space will be pretty much what we've seen in the KYC space in the past 3 years. So the big boom of KYC that we saw in the past 3 years, I think it will happen for the consortium space. Many products out there. I think only in the past year we have 5 new consortiums launched here in the United States. Different offerings. Some are pay to play, some are gift to get models. It's up to you to understand which product fits the needs of your financial organization, but also how do you use your product on a day-to-day basis? How do you build your strategy around everything you know about the customer, from your KYC or KYB process that you conducted, from your CDD processes? What do you know about the transaction? And how do you get, as fast as you can, real time is a great way, but if not in real time, then near real time, third-party insights about this entity and how they've been transacting for the past 3, 6 months, 9 months, 12 months with other financial institutions. And if you have red flags on all of those vectors, so you have a high risk associated during onboarding, the transaction is risky, and you get some type of feedback from a third party or from a consortium that this entity already been flagged for fraud, there's probably some actions you need to take. And with all that, we need to go back to the operational aspect of fraud prevention, and it's team training. So if we have agents who up until now have been trained to deal with mostly third-party fraud, so they see the user is a legitimate user and they try to protect the user, we need to start thinking about training programs of helping the agents understand that they might be dealing with a first-party fraudster. They might be dealing with a person who trying to exploit any opportunities that we give them on a platform, and how to detect those right red flags, how to understand that this person is up to no good, how to see the right red flags in the right time, and make them help make the best decision in the shortest amount of time, pretty much.
It's interesting, I think, Alex, hearing you talk about these various elements that all from a fraud perspective have this like through line of speed and pace around like getting information about the customer early, determining, within those attacks within the first 3 days of an account establishment, for example, or how best to resolve this through sharing data through consortia, and then making sure that your team understands how to respond to that and identify it quickly. And these are like very very sort of up to date of 2024 themes in a space that's always moved fast. And I think to some extent, I would admit, has moved faster than those of us more on the AML transaction monitoring side. But there's a lot to be learned from the transaction monitoring piece. I mean, think about the time spent, producing a SAR filing all related to a customer that was onboarded and some fraud vector, attacked and resulted in the termination of that relationship, with the exit of that relationship on day 1 or day 2 of that customer. Being able to get that information up front is really, really important. And I can't imagine, folks working in the transaction monitoring side, this mountain of stuff that they're having to deal with by day 1, 2, and 3, that they otherwise would have dealt with if it weren't for the high quality of the work done early on at the onboarding side and early in the detection and the training. So there's a lot to be learned, I think, on the AML side from all the good work on the fraud side. I've been involved in some of the consortia work in the AML space over the past 10 years or so, and there were some growing pains, but it's really exciting to see what's happening these days. Like you say, 5 new ones, in the span of about a year is pretty incredible. Well, Alex, obviously, I think that was super interesting. Why don't we turn over to some of the AML themes for 2024? I think now's probably a good time, as good time as any, to pop up poll number 2, and then we can get into it after that. But I'd love to hear, from the group about areas of the AML program, and you can also be thinking about your fraud piece here too. But really, from the AML program, which areas do you think you'll be getting the most attention this year? Is it things like your AML sanctions risk assessment? Is it the independent audit of the independent assessment of the program? Do you anticipate, dealing with issues around bank partner or third-party oversight, or your traditional transaction monitoring, including things like calibrating and getting coverage assessments and the validation of those? Or do you think it's going to be something more like just an overall drive around cost and efficiency?
Got those results populated now.
So, most people are really focusing on the transaction monitoring, calibration, validation. So, pretty sizable plurality there. Not too surprised. I think I'm quite interested to see things around like bank party and third-party oversight, but bank partner rather, and third-party oversight, which we'll come on to in a few minutes. And a fair bit of people interested in the sanctions and AML risk assessment. So good mix across the board, but obviously folks really interested in the TM piece. Unsurprising.
Yeah, I'm happy to see that some of the responders are actually thinking about the cost efficiency. And from my perspective, I see it a lot when I support our go-to-market goals, where really many financial institutions want to have one orchestration platform, and then maybe 2, 3, or 4 point solutions all sending data into that platform. And by having everything in one place, you can actually better understand the cost of your AML and the cost of your fraud programs, how much money you spend on those programs, and what is the efficiency, what they actually prevent, what they actually help you save.
Yeah, for sure. It's a really good metric, right, to see progress over time. Are we are we finding more stuff? Are we mitigating risk better? And how much are we spending to do it? So those input versus output is a super interesting concept to think about throughout the year. So we're putting together some thoughts, around AML compliance themes for 2024. One of the things that I've found over the years is, especially as a professional service provider, as a consultant, I'm always thinking about like what the next big thing is going to be. And probably starting like 15 years ago, started to say things like, well, AML was really big this past year. What's next, right? What's next year going to be? What's next year going to be? And every year I'm sort of proven like actually it continues to be AML and financial crime. And I honestly don't think 2024 is that different. We've already seen, a number of pressures, be they, regulatory and enforcement actions on financial institutions just this year, and we're not even done, month number 1 of the year. We came off the back of 2023 with several as well. So there's going to be continued focus on the effectiveness of those AML sanctions and KYC programs generally. This becomes particularly true around things like bank fintech partnership and those relationships. Several of those enforcement actions have been expressly related to vendor or third-party risk management as it relates to the fintech relationship. We could spend several of these sessions talking just about those, but we'll try to avoid that. But suffice it to say that this increasing focus or continued focus is finding its way down to the fintechs themselves and around things like their role and responsibility in directing or affecting the control framework from a financial crime perspective. Who owns those controls, where they lie, how well they're working, and how well are they being communicated back up to the bank itself. It's my view, and I think FS Vector's view, and probably most folks in the industry would agree with this statement, that those fintechs that invest in and spend thoughtful time and energy around their financial crime compliance program will be rewarded. And by rewarded, it's things like more sustainable bank partnership, maintenance and continued customer satisfaction, less friction, and a whole host of other benefits, including retention of personnel, just on and on. But I think it is safe to say that fintechs that get it right in the compliance program will be rewarded, which I think causes one to think about, well, what does that exactly mean from a fintech perspective? Like, what does it mean to get it right? Maybe we can move on to the next slide there, Erica, and unpack that a little bit. Clearly from the fraud perspective, as Alex described, the thing we're talking about when we talk about getting fraud right is making sure that we are actively mitigating and preventing fraud losses and addressing fraud vectors into the firm, into the company, and managing those losses and doing it efficiently, and deploying our resources across the systems, across the processes, the people, the data, what have you. From an AML perspective, the target is similar, but I suppose slightly different. The regulated financial institution has a regulatory obligation to maintain a reasonably designed financial crime compliance program that can deter, detect, and report potentially suspicious activity. That means that fintech firms, by extension, carry a similar responsibility. Their duty runs slightly different to the financial institution rather than to the regulator per se, but it's a similar target that one's after. They're looking to design a reasonable program around financial crime compliance. But I think increasingly for fintechs, we're seeing not just the need to have a program that is reasonably designed and operating effectively, but also be able to demonstrate that that's the case. And I think that demonstration piece and the clarity and the communication around that is going to be critical for 2024. And it's probably been critical all along, but I think we're seeing that increasingly over time. So I suppose, as I say in the slide here, in other words, show me, don't tell me that this program, be able to evidence that it is in fact a strong and effective program.
Yeah, if I can add a small comment, I think back when I was in the fintech space and I had my partner bank, I remember clearly that I had to proactively go to the bank and show them, this is my fraud strategy, this is what I'm monitoring, tell me more, tell me what to do, give me guidance. Because if you think about it, you have kind of general lines of what you need to do in terms of compliance and how to have, like you said, a reasonably AML program, but there's no guidelines for fraud prevention. And I remember that even my partner bank back in the day struggled to provide me with the guidance of what do I need to do to improve fraud prevention on my fintech program. And like you said, show me, don't tell me, and it goes both ways. And we finally see a shift in the fintech space where there's no longer growth at all cost. We're no longer looking at acquisition number, how many users you brought this month. We actually start to take risk and compliance as a factor into the lifetime value of the customer. So you're no longer looking at what was the cost of acquisition and how fast a customer can repay that. We also take into consideration, well, if that customer was non-compliant or they did some type of fraud, it will hurt the fintech. And more fintech founders understand that having a healthy risk and compliance program is essential for them to have good, steady, smart growth versus growth at all costs that we saw during 2019, 2021.
Yeah, that's really interesting. I like this whole question about, what are the guidelines? What is the measure of success in a fraud program, right? And in an AML program, I think it's a little bit clearer if it's slightly more like abstract in nature. On the fraud side, it's mitigating the fraud losses and all the things that go with that. So in terms of some practical things that I think are going to be relevant for the year ahead, across the AML and the FinCrime program generally, I always like to break things down in terms of the program sort of beginning to end, in terms of designing that program, operating it, monitoring and making sure that it continues to be functioning appropriately, and ultimately subjecting it to testing and independent assessments of that program. So, a few of those items that showed up from the poll a few moments ago, show up, unsurprisingly on the page here in different parts of that program lifecycle, as it were. I think that we're going to be seeing an increasing amount of interest and scrutiny, as it were, over things like the risk assessment. And this is, risk assessment has been one of those topics that is sort of top of mind in the FinCrime space, probably has been for the past 10, 12 years. It's a funny one in that for most regulated institutions, not all, but for most, there's no express requirement to have a risk assessment. The requirement is probably to have a risk-based program or reasonable program. And so there's an implicit understanding that one needs to understand where the risks are so that it can have a program. But that's been underscored over the past few years, and the risk assessment itself has sort of risen in prominence to become, the real foundation, the driver of the rest of the program. And if you can imagine a fintech partner bank that requires that its programs have a risk assessment, I think that in the year ahead, we're likely going to see increasing demands and requirements around the thoughtfulness, the potentially the sophistication, the just amount of energy and sort of illumination over the risks that are documented in that risk assessment. And there will be an expectation. This isn't just sort of a once and done, do it each year, perform the risk assessment, refresh it, and put it back on the shelf, but rather that it really does capture the risks that the firm is exposed to. And that, I think, also applies to fraud risks. Think again about that 25% figure that I mentioned at the outset. I think a good AML sanctions risk assessment needs to acknowledge the fraud risk that's there, even if that's a standalone risk assessment on the fraud side. And then the rest of that program needs to be developed and are sort of articulated around the risks that are coming from the customers, the products, the geographies, and other things that that firm, the fintech, is interacting with and playing in that space. And that includes things like setting up the transaction monitoring rules and coverage so that they adequately address the various risks that are coming, both in the transaction, the AML transaction monitoring side, but of course on the fraud vector side as well. So we're increasingly seeing, clients and their bank partners wanting to talk about, fraud typologies at the same time or simultaneous to when they're talking about your traditional rule coverage from a transaction monitoring side. I think we'll be seeing more of that over time. In terms of operating the program, sort of unsurprisingly, there will be continued focus on, the sort of cost pressures, the operations of that program, how well things are actually working in practice. Not just do you have a policy, do you have a high level procedure, but actually have you mapped out the controls themselves, the process steps, where the handoffs take place? Are people actually doing what we think they're doing in the controls? Are there workarounds, that sort of thing? And of course, are people trained and capable of handling the work that's on their plate? Alex described the training aspect as being, look, this is new. There are things that we're training today that we didn't really think that much of 12, 18 months ago. And those are going to continue to change. And we need to make sure that our analysts, particularly those that may be somewhat double-hatted, doing fraud-related alerts and investigations, as well as AML transaction monitoring alert and investigation type work, that they are facile with those different aspects.
Yeah, and if I can add, a clear shift that we are seeing in Unit21 today is we'll have a fairly early day fintechs who are being referred to us by their partner banks and by the banks who run their BES programs. We didn't see that 2, 3, 4 years ago. 4 years ago, somebody decides to start a fintech. Chances are they building their transaction monitoring in-house. They have some type of dashboard, they have some type of alerting system. Sometimes the alert go into a Slack channel, some workaround, and it's not working. It's not scalable. The engineering cost behind it is huge. You have to maintain it. It's not flexible. This year, 2023, 2024, we see those new fintechs being referred from day one to a risk infrastructure vendor who can help them set up everything straight from day one. And I think this is a huge step, both for partner banks or banks who are just doing banking as a service. I think this is definitely the right way to go.
Yeah, and that extends to things like the monitoring and reporting, right? And what metrics are being captured. How about the issues, those issues that are identified as part of the risk assessment, those are the issues identified in the course of day-to-day business or in the course of forming, user acceptance testing or other things of that nature around the Regtech solutions. How well are those issues that are being identified being monitored and addressed and acted upon and resources dedicated to handling them? We're going to be seeing more interest, I think, in line of sight into the metrics and ongoing operations, as well as the issue management within fintechs in 2024 than we've seen in the past. And last, I know it didn't show up particularly prominently in the poll, but I'll be slightly subversive here. I think that independent assessments and model validations in 2024 will be more important than maybe we've been giving perhaps attention to in the past, and that those independent assessments, the validations, will be more highly scrutinized than they have been in the past, and put to a level of rigor and discipline that maybe in the past they haven't necessarily been subject to. I don't mean in any way to diminish the work that's been done in the past, but I think that the amount of pressure placed on that independent assessment as a discipline and model validation as a discipline will continue to rise. The only word I would say on model validations is, I think the old debate about whether the AML or the fraud tools and rules and detection methods rise to a level of a model or not is somewhat moot, I think, at this stage, by and large. That debate's been settled, and that to the extent that they exist and there's data lineage, that there is conceptual soundness, that there is good coverage of the actual risks and things of that nature, whether or not a detection method is a model is sort of beside the point. That I think the level of risk management and governance placed over that will continue to rise over time. So those are my main predictions in the financial crime compliance space for the year ahead. I think they echo a fair bit of what we've heard from Alex, although maybe in slightly different ways, and of course they differ in some ways as well.
Thanks, Chris. I think it makes a lot of sense to look at what you just described from operational perspective and testing perspective, and break it down to really understand what is the responsibility of the fintech, what is the responsibility of the bank, how they can cooperate with each other, and it helps a lot to build much healthier program. Now let's dive, I think, to what are the actual steps towards a FrAML approach or an orchestration approach. And there's 4 points that I would like to touch here. So the first one will be establishing cross-functional collaboration, which is essentially encouraging collaboration and communication between the fraud and the AML team. If I have to just summarize that, the operational opportunity for fraud and AML team working on the same platform is huge. Like you said, if 25% of the SARs that have been filed come from a fraud case, then it absolutely makes sense that the AML team has a direct avenue to the fraud team and vice versa. I also think that by having those direct avenues, those teams can actually go and improve each other and help improve internal processes and how they collaborate with each other, and then what is needed to be reported and what doesn't need to be reported, and how they want different data and different signals to be reported back and forth. I think it's super critical. The other point is united risk assessment. And here I'm wearing my fraud prevention hat. And I think that if I have a good way as a fraud prevention manager to clearly show the BSA officer what the risk I'm dealing with and show them where is my high risk exposure in the program and how I mitigate and control that risk, it will help bring unified risk assessment. You might, Chris, maybe you have a different thought on this, but I think especially for a fintech, it makes sense to build one unified risk assessment, and as they grow, they can start branching out.
Yeah, it's interesting. I think there is no sort of one size fits all standard of what a risk assessment needs to look like, and a big part of me likes the idea of unifying them as much as possible. I also have this feeling that there's an increasing expectation that the firm should be able to describe and document its money laundering risk as distinct from, say, its sanctions compliance risk and fraud, and that if we are able to sort of thread that needle and produce a risk assessment that can address all three, that's great, and we should do that. But I think we also need to make sure that we're answering the mail, as it were, about what the money laundering risk is, what the sanctions risk is, and what the fraud risk is. But it'll be really interesting to play with that over time and continue to sort of push towards unifying those risk assessments.
Yeah, absolutely. And for the next point, regulatory and compliance goes back to what you just shared with us on how effectively you build a program. I'm a strong believer that having one orchestration platform actually helps the supervision and control. It helps to see in a much clearer way what is happening on the platform, where is the risk exposure, what fraud team is doing, what the AML team is doing, where are the gaps. If we see fraud losses or we see AML cases that we were too late to find, and we were too late to discover. And obviously that exposed us to certain regulation and compliance issue. It's much easier to do the investigation and come up with clear conclusions on one single platform where you have all the relevant data and all the relevant people accessing that relevant data. And the last point is continuous improvement. It's never-ending cycle, really, when we fight fraud and money laundering. The fraudsters keep adjusting their strategies, and so do we. We have to keep up. We have to keep thinking, where are the gaps? What are they exploiting? How we can cover those gaps? Having a direct channel and direct avenue of communication between all the relevant people in the risk and compliance space in your organization is really the way to create continuous improvement.
I mean, I couldn't agree more in the end there, Alex. That's the point of all this, right? Is to continue to get better, address the regulatory requirements, collaborate better, become more operationally efficient, but also more effective at the same time. It's great.
Well, thank you, Alex and Chris. I think that just wraps it up about today. Thank you for the discussion, super insightful. Now we want to hear from anyone on the call. Let's take the last few minutes here to answer any questions that have come in from the audience. All right, let's see. We've got some questions coming in here. So we'll start with this question here. Alex or Chris, feel free to take it. For those of us who are thinking about aligning our fraud and AML functions, where do you think we should start?
Well, I can take it from the fraud perspective, and one of the key elements that are quite often being missed in many fraud programs in fintechs is understanding the acquisition channel. Understanding that there is a difference in risk from your organic channel, a channel where applicants come through without seeing any promotion, without seeing any advertisement. They just genuinely go to your onboarding landing page and start the onboarding process, versus applicants who come through you either through mass acquisition or through expensive acquisition channel where you pretty much cherry pick the people you want to advertise to. There's different risk levels to that. And I think it's important to have this conversation between the risk and compliance people of where in our risk assessment we put the acquisition channel. Where is that place and how much weight we provide in our risk assessment to those different channels. It can help us to provide a good feedback back to both to the continuous monitoring and what do we need to report, but also feedback back to the onboarding flow and to the controlling the funnel of understanding. Maybe I don't want to run the same KYC process for everybody. Maybe I just need to make some adjustments by understanding where the applicant is coming from.
Yeah, I think that's right. Eric, also to not make it too glib, but just get the teams in a room to work together and collaborate. And I think that mapping out those processes and how they interact and where the systems may be able to be aligned is one of those exercises that's just like worth doing from an operational, effectiveness and an efficiency perspective.
Awesome, thank you. Oh, go ahead, Chris.
Yeah, no, I was just going to say there's a couple more questions there in the chat. Let me take the third one first. I see it actually goes farther than that. But take the third one about thoughts on internal versus third-party audits. My view on this one is I don't think it matters. What matters is the independence of that party and the capability of that party performing it. Particularly if you have a contractual requirement from your bank partner, for example, to have one performed. If you wish to do it by an independent third party, that's fine. It should be a party that was not involved in developing the program in the first place. And if it's somebody internally, just make sure that they have the capabilities and the skills to do it and that they're also independent. There's also the first question that came in about thoughts on segmenting compliance and risk, where risk manages fraud and AML, compliance team audits, ensures training, implemented and assists and updated processes. I'll let you read the rest in the chat if the folks are able to read it, of the participants. I don't think I have a strong view on this one. I think that however the program is overseen and governed, it needs to be clearly articulated about who owns the controls, who is managing the risk, and then who is providing that sort of like advisory guideline role that your typical compliance function plays. I've seen firms, like including some pretty large ones, that have started where the compliance function owns all the investigations work and the operations of it, and then eventually migrated that over to the so-called first line of defense, which I think is what you're talking about here in the risk team. And I've seen it work the other way too, where it was in the first sort of line with the business and the risk team, and then the organization found it more effective to move it up to compliance. So I think either one can work. Just make sure that it's sort of a thoughtful, directed approach, and that you've got the right people in the right seats, and they're got the right reporting lines, and using the right systems and collaborating appropriately.
Thank you.
Yeah, and I can take the question about what transaction patterns or activity have you seen which led to successfully identifying money laundering? And I think before we look into patterns, it's very important to understand the inbound risk and the outbound risk in your program. I mean, if you're operating on a program that only offers, for example, ACH payment, then this is your only avenue of inbound and outbound money flow. But if you have an ACHs and you have wires and P2P transaction and internal movements between money movements between users, and then you also issue cards and you allow maybe money to come internationally. So it really depends on all the different rails and all the different avenues that money can flow in and flow out of your system. And then when you understand the inbound risk and outbound risk, you need to build a matrix that tells you, this is the product offering for the user. What do we think is a normal usage? What is abnormal? What is abnormal and must be reported off the bat? And this is a good way to start thinking about looking for money laundering, but obviously depends on all the different avenues that you offer to your end users to bring money in and out.
Awesome. Thank you, Alex. We've got one other question here. What are some examples of KPIs that organizations use to measure the ongoing effectiveness of their fraud prevention strategies within a FrAML framework? And this could be Chris or Alex.
I can take it. I think when we talk about KPIs, KPIs at the end of the day must help us justify the investment in the tools, right? So if we're talking about FrAML as an infrastructure, it's important to have categories of KPIs. And the first one is fraud prevented. If you're operating in real time and you actually taking live actions on certain transactions and you interrupt the authorization process, you can start measuring things like fraud prevented. You can, but if you're measuring fraud prevention, you also need to measure friction. You also need to understand, well, you might prevent millions of fraud, but what is the cost of friction to your end user? Then you need to start thinking about fraud detection. So how much fraud is actually being detected by the team? If you have a team of, let's say, 10 agents, and those 10 agents get X amount of salary, what is the impact you expect those agents to have on your organization? Besides that, I think there is room to start measuring efficiency in terms of ratios. So how many alerts were generated? Those alerts, how many alerts turned to cases? Those cases were investigated, eventually turned to SARs. So what's the funnel looks like there? So alert to case to SAR ratio. And after all that, you could start measuring the efficiency of the team. So how fast or how slow the team respond to fraud cases, how fast or slow they escalated to the AML team, and the AML team, are they keeping up with the SLAs that they need to keep up for investigation and to make a decision whether or not to file a SAR? So many different things you can measure, what's important is to actually measure something. We see quite few financial organizations who don't have KPIs. They just have the bottom line at the end of the year. We lost $5 million. Great. But if we don't understand where the loss is coming from, if we don't understand what we did wrong in order not to capture those losses, in order not to prevent them, it's very hard to say, okay, how do we improve next year? So break down the KPIs and start measuring and be granular as you can.
Thank you, Alex. And we've got one more question here. What are your suggestions for title companies? It's a bit of a gray area with AML.
Yeah, I can start. I mean, a little bit of a tricky question because it could be like, is the title company a customer, or you have a whole segment of customers that are title companies? How does one mitigate the risk of those? I go back to the risk assessment as a thing, and really give some thought to, well, what is the nature of the title company, and what is it about them that makes them potentially higher risk? What are the types of transactions and activity that one might expect to have if you are servicing a title company, and which way you're servicing that title company? And then the levels of due diligence and whatnot that you place on the company themselves, but also like what sort of diligence they're placing on their own customers, and how that sort of behavior has been sort of trended over time. A little bit tricky, I think, in the abstract, but I would say the first step is to go back to the fundamentals in that risk assessment and think very carefully about what it is about that customer. And that's true whether you're a title company or some other, cash intensive business, or certain industry types that are, unique in some way and not unique in other ways. So risk assessment.
Awesome. Thank you both. I think that is all that we have time for today. Chris, Alex, thank you so much. And to everyone that spent the time with us, we really appreciate it. Before we depart, I wanted to share that immediately after this session, we will have a very brief survey. It's our aim to make these sessions as helpful as possible. So please let us know what your thoughts were. And thank you, everyone. Have a great rest of your day.
Thank you so much.
Bye.